Welcome back, everybody. Today we're talking about everybody's favorite liquid crack dealer, Starbucks. I'm kidding, of course. Now, we love Starbucks in this house, so much so that my wife has a Starbucks AirPods case. What type of person gets an AirPod case with Starbucks on it? And I go there all the time for myself or for the family, and even my dog loves his pub cups, although he doesn't really know how to act afterwards. But you can love a company as a customer, but not necessarily love it as an investor. But Starbucks investors, at least recently, have done pretty well. Starbucks is up almost 100% in total return over the last 5 years, outpacing the S&P 500. Their rewards program is one of the most popular in the world and gives them a competitive advantage, which we'll talk about. But they've also increased their total debt over the years and are dealing with their store workers unionizing in different areas of the country. So is Starbucks stock a buy right now? Let's find out. So if we jump into Seeking Alpha, we see that Starbucks is currently trading at a price of $95.48. Over the past 12 months, they're up 9.26%, and year to date, they're actually down a little over 5%. Starbucks currently pays a dividend yield of 2.22% and a dividend rate of $2.12 per share. That's a lot of twos. So if we look at their dividend summary, we see their yield and their payout. They have a payout ratio of 64.24%, a 5-year dividend growth rate of 10.97%, and consecutive years of dividend growth at 12 years. All right, so if we take a look at the profitability tab, just to look at their margins, we see their gross profit margins 26.56%, their net income margins 10.8%, their free cash flow margin is just under 8%. So return on equity, Starbucks has an NM. This is because Starbucks actually has negative shareholder equity, which we just talked about in my last video on Lowe's. So it'd be interesting to dig into what Starbucks' situation is, how it's similar to that, and how it might be different. So if we look at the growth tab, we see that their projected revenue growth going forward is a little over 11%, which is pretty good. And if we look at their earnings growth, it's a little bit under 8%. So ideally, I would like to see earnings and free cash flow growth higher than revenue growth, because it means that they're constantly converting more and more of those revenues into profits and into free cash flow. Now for Starbucks, projected growth with free cash flow and earnings is lower than that of revenues, but at least on the revenue side, because they're projected to grow about 11%, which is actually above their 5-year average, that's at least a good place to start. Now if we look at the momentum tab and just look at total return, in the 5 years, Starbucks has outpaced the S&P 500 pretty well. In the 10-year, it's a little bit closer. They're right there kind of neck and neck. Starbucks underperforming just a little bit. And then obviously, if we look over 30 years, Starbucks has crushed the S&P, which is no surprise. They've been a really good performing stock for quite a while. So now that we have an idea of where the stock is at, let's talk about what's going on in their business. Starbucks is the most popular coffee company in the entire world. They have over 37,000 stores in 80 different countries. And no matter which one you go to, that slow person who's not using the app, doesn't know the menu, and insists on paying with cash is going to be in front of you in the drive-thru. It's just how it works. So let's take a look at Starbucks financials. And I want to take a look at their debt first. And it's good timing because I was just talking about Lowe's and McDonald's in my last video about how they had negative shareholder equity because they were taking on a lot of debt and buying back shares. And Starbucks is in the same boat, using the same type of capital allocation strategy. And similar to Lowe's, they had identified a sub-3 debt-to-EBITDA ratio that they wanted to stay within. And for Lowe's, actually, it was 2.75, so it was a little bit lower. And when you look at their debt-to-free cash flow ratio, it's 13.61, which is quite a bit higher than Lowe's and McDonald's, which we talked about last video. The Starbucks has a similar credit rating as those two companies as well, with S&P Global also rating Starbucks at BBB+. Now, when we look at Starbucks' long-term debt profile in their financial statements, it actually looks pretty manageable with only $140 million in interest payments on the debt. So even with the higher debt to free cash flow ratio, they actually have a higher interest coverage ratio than McDonald's or Lowe's. So I think we have a pretty decent understanding of where they're at from a debt perspective. But let's take a look at their revenues and how they did with Q3 earnings. And this is a great example of why you can't just read the headline. It says Starbucks misses comparable sales estimates after North American transactions stall. So that sounds pretty negative, but when you actually read the details in the article, it's a different story. We see that Starbucks revenues were up 5% for the quarter, but more importantly, were up 12% year over year. And if we look at free cash flow year over year, basically taking cash from operations minus CapEx, Starbucks is up over 27% year over year. And that's really good revenue growth in my opinion, especially when you compare it against other retail companies. Now, McDonald's had a really good quarter with double-digit revenue growth, but for most of them, that's not the case. Starbucks beat on earnings, but slightly missed on revenues. Their global comparable sales grew 10%, but they missed estimates of 11.1%. The average global ticket was up 4%, and transactions were up 5% for the quarter. Now, comparable sales in North America were up 7%, but 8.1 consensus was the expected number. They were driven by 6% increase in average ticket and a 1% rise in comparable transactions. So the headline looks like they had a bad quarter, but they had double-digit revenue growth where they were able to either raise prices or get people to buy more things, and they didn't lose any transactions. For a retail company, that's good. Their operating income was up 10% year over year. International comparable sales rose 24% for the quarter, and China specifically rose 46%. Active membership in Starbucks Rewards programs in the U.S. was up 15% to 31.4 million during the quarter. And they opened 588 net new stores with a total now of 37,222 stores globally. So overall, a really good quarter and continued consistent growth from Starbucks coming out of 2020 and 2021, which were the pandemic years. And the numbers really hit on a few different strengths of their business, so let's talk about those. And one of the biggest advantages that Starbucks has is its rewards program. Not only does the app and Star Rewards keep customers coming back, ordering more, and staying engaged with the brand, but mobile ordering helps improve operational efficiency and margins. And best of all, the loading of cash into gift cards and your app balance makes Starbucks almost like a de facto bank of their own. And they hold roughly $1.8 billion in what's effectively an interest-free loan from their customers. And unlike a bank, they don't need to pay anybody yield on that money. They can use it to invest in their business, get some interest income, or just give them general flexibility for whatever they need it for. And the rewards program continues to grow in use and customers every year, so it's a benefit that they're going to have for the foreseeable future. And speaking of growth, while U.S. stores are probably closer than not to a saturation point, Starbucks still has opportunity with global expansion. In China, Starbucks saw revenues up 51% year over year, but that was with the lockdown being in the previous year, so it's a little bit of a skewed number. But coffee consumption in China is on the rise, and they've seen growth in their rewards program there as well, with over 20 million active accounts. In India, they're experimenting with cheaper drink alternatives and Indian-inspired tea offerings to appeal more to the customers there and help penetrate a market where currently only 11% of Indian homes drink coffee. So gaining new customers globally is definitely possible, but they're finding ways to earn more from existing customers as well, which brings me to my last advantage that I wanted to touch on, pricing power. Now in the US, Starbucks has over 16,000 stores, so growth likely won't come from opening new ones. Where it likely comes is from pricing power, increased ticket sizes, and improved margins. And they talked about ticket prices being up in the most recent earnings call, and the reality is that prices have been rising, but customers and transactions have stayed the same and even grown a slight bit.
We like buying businesses where we feel that there's some untapped pricing power. I would say you can almost measure the strength of a business over time by the agony they go through in determining whether a price increase can be sustained.
And this is the benefit of Starbucks. Now, is a $5 coffee expensive? Yeah, but it has the properties of being an affordable luxury that people are willing to pay for. So maybe you can't afford that iPhone Pro Max or that Tesla or that beach vacation, but you can afford to be able to give yourself that customized coffee drink that you love every day. And this affordable luxury term is something that Starbucks has actually talked about and used in their own earnings call, describing the strength of their business and customer loyalty. And that's what makes Starbucks an incredibly sticky product, even with incremental price increases. And on ticket sizes, they're still looking for additional opportunities. On their most recent earnings call, CEO Laxman Narasimhan said that the company sees significant opportunity for food and will share more information soon. And as it relates to margins, Starbucks continues to focus on digitization through the app as well as drive-through stores to help improve margin. They have drive-thrus in 70% of their U.S. store base now, which historically generates higher sales volumes and higher margins. So they really have revenue growth opportunities in multiple areas right now, with a customer base that's extremely loyal and willing to pay incrementally higher prices. That's a really good combination. Okay, all that's great, but no conversation about Starbucks will be complete without talking about the union issues they have going on. So Starbucks has had a mess on their hands as it relates to their baristas and unionization. Since 2021, over 300 of Starbucks' 9,000 plus company-operated U.S. stores have voted to unionize. And workers are seeking things like guaranteed minimum hours, gender-neutral store bathrooms, safety improvements, among other things. And then in June of this year, there was more drama when unions said workers were instructed to take down Pride Month decor in stores. And of course, because this is 2023, there was a bunch of posturing and attempted canceling online. And Starbucks' view on this is that they've always been a supporter of the community and their workers, and their policies hadn't even changed. The issue had to do around not covering up windows and baristas' viewpoints, as well as safety concerns. But you know how these things go. There's a lot of drama, it blows up online, and it's rarely resolved in any kind of productive manner. And as recently as July, a National Labor Relations Board judge ruled that Starbucks failed to prove that it didn't close down 3 Ithaca stores due to worker unionization, a ruling that Starbucks strongly disagrees with. But basically, Starbucks is being accused of targeting and firing unionized workers and/or closing their stores in retaliation. And the issue with these type of problems is that they tend to linger and grow and snowball as unionization efforts and then the media narrative start to feed off of one another. But Starbucks, I think, is trying to handle the situation as best they can. They've tried to improve the issue by investing in additional training and store innovation, making scheduling improvements, and improving economic incentives for their workers. Take-home pay for baristas has increased 20% year over year, and barista turnover is down 9% year over year. Now, obviously, these things always have a little bit of give and take because increased pay and benefits also means increased cost. But if you're able to get improved employee retention and efficiency, and it helps reduce the uncertainty around all the unionization efforts, then it'll be money well spent for the company, the employees, and investors. Okay, so we have a decent idea what's happening in their business. Let's take a look at their valuation real quick. All right, so we jump into the spreadsheet. We see the data that's already been pulled in. If we look at their dividend growth rates, they've had really good dividend growth on the 10, the 5, and the 3 year, along with the 12 years of consistent dividend increases. Now, in terms of their dilution trend, it's down. From a moat perspective, they have a wide economic moat, according to Morningstar. And then, have they ever outperformed the S&P? We already looked at the momentum tab on Seeking Alpha. The answer is obviously yes. So one thing that you might notice is that the payout ratio on the spreadsheet is quite a bit lower than what we show here on Seeking Alpha. And the reason for this is that different websites calculate these things slightly differently. So on Seeking Alpha, this is calculated by using the dividend per share relative to the earnings per share based on non-GAAP principles, whereas other websites may use a different earnings number, which can cause a discrepancy. But ultimately, we know the general range of what their payout ratio is, so it's not a huge deal. So if we look at the discounted cash flow valuation for Starbucks, we see that after adding our cash from operations, our CapEx, and our stock-based comp, we get a fair value price per share at the incredibly low $27.74. Now, let's talk about some assumptions we're using and try to understand what's going on. So in terms of starting cash flow, I'm using the average free cash flow since there's some variability in the numbers. For starting growth rate, I'm using 3.5%. Now, the calculated one here is negative 20%, so that number's not very helpful. But again, if we go back to their growth tab on Seeking Alpha, we can see that the estimated operating cash flow growth is projected to be a little under 3.5. So I'm using 3.5. Now, anytime I see a fair value price per share that's this low compared to where a stock is trading at, it makes me pause a little bit and wonder if there's a better way to look at it. Now, obviously, evaluating stock based on discounted cash flows definitely has its benefits, and it's a method that in general I do believe in, but it doesn't always work for every stock, and it's not always the best indicator of how a stock is going to trade going forward. But let's take a look at the multiples valuation and see what that tells us. So if we look at the multiples valuation for price to cash flow, I've added these peers: McDonald's, Chipotle, Restaurant Brands International, and Yum Brands. And when we look at the calculation and fair value price per share, it comes out to just under $80. Now, obviously, it's still quite a bit away from the $95 that Starbucks is trading at, but it seems a little bit more reasonable than the $27 we got with the DCF model. And then if we look at the multiples model with the same peers as it relates to price to earnings, again, we get $86.05, which seems to be in the ballpark of the previous multiples model. And if we look at the different valuations together, we see that the analyst mean price is about $113.51, which is quite a bit away from all the different valuations that we did. So in these cases, I want to look at something else than just these valuation models. Because obviously the valuation models that I'm using aren't a really good indicator of how Starbucks is trading, and they're not a good indicator of how other analysts are viewing their business either. And what I normally do in that case is I try to take a look at what their historical price to earnings and historical price to cash flow have been to see where the stock is at relative to those measures. So if I keep price return in here and I take a look at price to earnings and price to cash flow, and I update my chart, let's look at it over 5 years. And then I can kind of see that where Starbucks is trading right now, in terms of price to cash flow, a little over 21, price to earnings at 29. when I look at where it's at before, here it was price to cash flow a little over 16, price to earnings around 20. That seems to be like a relative value area historically for Starbucks in terms of whenever it hits that area, the price seems to kind of rally a little bit. So again, if you're holding long term, then when you get into these things isn't as important as if you feel strongly about the business. Because if the business keeps growing, then the price to earnings that you got in at isn't going to be a huge deal over 5 to 10 years. But just based on these numbers alone, what it would tell me is that being that we have price to cash flow at about 21, price to earnings at about 29, that it is maybe a little bit overvalued from its historical, like really great buying range, which I would put maybe price to cash flow around 16, price to earnings around 20. But again, valuation in that level, in my opinion, only really matters if you really want to get the absolute best price every time you buy a stock. Okay, so let's look at Starbucks based on the 3 primary criteria that I use when I analyze stocks, which is business, operational performance, and valuation. So in terms of business, I think Starbucks is in a good spot. They have an iconic brand with pricing power, they have a rewards program, which is a competitive advantage, and they've shown good revenue growth with additional revenue growth opportunities. So from a business perspective, I would rate them as good. So from an operational performance perspective, they've shown recent free cash flow growth that has been very good, but they've taken on a lot of debt over the years, and their debt to free cash flow ratio is over 13. Then obviously, they have some issues going on with their workers and unionization, so overall operational performance I would just rate as okay. Now from a valuation perspective, their DCF model was nowhere close to where they're trading at today. Now if you look at other measures like price to earnings or price to cash flow historically, it doesn't seem as bad, but I think for consistency's sake, I'm just going to use what the DCF model says, and I have to rate it as poor. So is Starbucks a buy now? Now, I don't love their debt and their negative shareholder equity, and that was the primary reason that I was starting to reevaluate my position in Lowe's, which I ended up selling. But Starbucks does have relatively small interest expense on that debt, and I think they have quite a few advantages as it relates to revenues and cash flows. So they have consistent cash coming in from the rewards program, as well as healthy revenue growth. There might be some questions about growth in the US and how costs will be impacted by the union stuff, or if they can continue to raise prices, increase ticket sizes, and or margins. But I think their business prospects are really good, and they have multiple levers on the revenue side to achieve growth that all have promised to me. And in terms of unions, it is unpredictable and it is uncertain, but I do think they're taking the right approach of just trying to improve things to make them better and not get baited into any political debates. Because Starbucks is basically just saying, we support our workers, we've always supported them, and here's what we're doing for them. So they're just trying to get things done, because you're never going to win a political debate. So they're just trying to put work in to make progress to actually move the issue forward. I don't love the uncertainty around it, but I do think that on a relative basis, they're handling it pretty well. So obviously Starbucks has a dividend growth history that's really strong. And if I go back to my portfolio strategy, it's basically companies that generate increasing cash flows and reward shareholders with dividends that grow above the rate of inflation. So yeah, to me, Starbucks is actually a buy, but with some caveats. Now for me, I already had McDonald's in my portfolio, which is a similar company. So initially, I really had no plans to add Starbucks in my portfolio. But for full transparency, while I don't have any Starbucks in my portfolio, my mom actually has about 50 plus shares of Starbucks in her portfolio, which I manage for her. So just want to be completely transparent with you guys. I don't own any, but we indirectly own some through her. But the crazy thing is, Starbucks looks a lot better than I thought it would. And I think the bottom line for me when I compare it to the decision that I made around Lowe's is that I just don't like Lowe's' business and prospects as much as I like Starbucks' business and prospects. And maybe that's because I don't understand Lowe's business as well as I understand Starbucks. Because even now, Starbucks is a company that has a lot of things going on that I don't necessarily love. I mean, they do have a lot of debt, they have uncertainty with the union stuff, and their valuation isn't great right now. But at the end of the day, they have a great business with pricing power. It's a product that people love, in some cases are literally addicted to, a brand that they're loyal to, and their investments in technology have created a digital ordering process that also helps drive their rewards program, which is a huge competitive advantage. So Starbucks is one of those companies, I think, where when you look at what's going on around them, sometimes you're like, oh, I don't want any part of that. But when you look at what I view as the most important aspect of a company, which is their core business, Starbucks is a great core business that's going to continue to make money. And this is the same feeling I have about Apple and McDonald's. You can always find things to nitpick and reasons why it's not the right time, but I feel like when you have companies that take that most important question and really knock it out of the park, then it's never a question of if you should add it to your portfolio. It's more of a question of when do you feel comfortable adding it. So those caveats that I was talking about are basically the aspects of the operational performance and the valuation that you need to have changed before you feel comfortable adding it to your portfolio. Is it when it hits a certain price or valuation? Is it when the union issues start going away a little bit more? Is it when the debt isn't as high as it is now? And those are questions that you have to ask for yourself. Now, for me, because I had McDonald's in my portfolio, I was pretty sure I wasn't going to have any interest in adding Starbucks. But after going through this full exercise, I've actually changed my mind on that. So Starbucks is going to be on my watch list and something that I'll likely add here in the near future if it stays at these price levels or maybe goes even lower. But there was a few other companies that I was evaluating and wanting to look at. So I'm going to do that first before I make any other decisions. So what do you guys think of Starbucks? Is it something you want to add? Let me know down in the comments below. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you guys in the next one. Peace.